Hey guys, how's it going? Solo back, and I thought I would keep a little bit of an educational video going on for you today. And so what I wanted to talk about was call credit spreads. And this is a strategy you can use if you want to play some theta strategies, but some of the stocks you want to play or the tickers you want to play are just a little bit too expensive for you, and you can't run the wheel by selling cash secured puts. So one example stock for me would be Tesla, right? Because Tesla right now is trading at $652. And in order for you to trade even one put or sell one put on it, you would need $652 times 100 shares. So you would need $65,200 right now to be able to trade just one put, sell one put on Tesla. So obviously that's out of the reach of a lot of people, including myself. But let's say you do want to trade Tesla, and let's say the market's been on a little bit of a correction, a little bit of a downturn lately, especially big tech, and especially something like Tesla. I mean, if we look at the 3-month graph here, Tesla is down 2% over 3 months. Past month is down almost 14%. So let's say you think you're a little bit bearish right now on Tesla in the short term, or maybe even the medium term, and you want to be able to cash in while Tesla is potentially selling off. So one thing you could do would be to buy put options, but let's say you don't want to buy puts. Let's say you want to play more of a theta strategy. So one strategy with a defined reward and a defined risk is going to be call credit spreads. So if you're not familiar with that, let me show you how to trade a call credit spread on Robinhood. And obviously you can do this on any platform as long as you have the appropriate options level active on your account. What you're going to do is on Robinhood, you're going to go obviously to the options chain here, trade Tesla options. And this is going to be a 2-leg option. So you're going to need to open up 2 options at the same time, and Robinhood will let you know if you did it correctly or not. But let's just say, for an example, Tesla right now, like I said, is trading at $652.20. So the first option that I like to open up is the sell option. You're going to end up selling one option, a call option, and you're going to end up buying another call option. So I always like to start with the sell option, because that one, the strike price you choose for the sell option is the strike price or the share price that you need your stock to stay below. So just to keep things even, let's just say I think Tesla is going to trade below $655. And obviously you can choose any expiration you want. Right now we're on the default weekly option, but you can go out to 2 weeks, 3 weeks, you can do monthlies. I mean, you could honestly even go out to years, right? You could go out to March 17th, 2023 if you wanted to. But let's just say I'm just bearish on Tesla this coming week, for whatever reason, maybe it's news or whatever. But my theory is that, just for example, that I'm bearish on Tesla. And like I said, I think Tesla is going to trade below 655 by March 26th. So the first option, like I said, I'm going to sell this call option. So I'm going to click the plus sign here. And now you can see just having one option up in my little checkout window here, the platform thinks I'm just trying to sell a call. So it's a short call, and my total credit would be $24.70 per share. But now keep in mind, I would have to put up $65,500 in capital, which I don't have. So in order to make this manageable for me, my next option to be able to turn it into a call credit spread is going to be to buy a call option. Now the option you buy is going to be higher in strike price than the one you just sold. So I can choose this one for $657.50. I could choose $660, $662. I mean, I could go all the way as high as I want. Now, the option that you pick is going to determine your max profit, but also your max loss. So for example, let's just say I go one strike above. If I add the plus sign here, you can see if you did it properly in your little order window here, it's going to say call credit spread. So Robinhood has realized that you're trying to trade a call credit spread. And then also you should be receiving a total credit, hence the name credit spread. So right now, by opening these 2 positions, I would receive a credit of $1.70 per share times 100 shares. That would be $170. And you can see I'm selling the 655 call, and by selling it, I would be receiving $24.70. And then I'm going to buy the 657.50 call, and for that I would have to pay $23. And so the difference between those two becomes $1.70 net credit. So now your max profit is this, the total credit you received. So for these 2 options, for this call credit spread that I've set up, my max profit is $1.70 per share times 100 shares, which is $170. Now Now you might be asking, well, what is the max loss? The max loss is going to be the difference between these two strike prices, subtracting your credit that you received. So these strikes are what we call the width of your strikes is $2.50, right? Because 657.50 minus 655 is $2.50 per share. And remember, every contract is 100 shares. So $2.50 times 100 shares is $250. So if I make this trade, my max profit is $170. My max loss, I said, is $2.50 because that's the width of my strikes, which is going to be $250 minus, however, the credit that I'm receiving is $170. So actually my max loss is $80. So as you can see, really, I would only need to have $250 of capital in my account, really, to be able to trade Tesla, which is a lot less than $65,000. But because of that, my max profit is also limited, right? Because if I didn't sell this other option that I bought, my max profit just by selling this call would be $2,470. So I'm limiting my max profit, but I'm also limiting my max loss. Now, one way to make sure that you also do this correctly, because you always want to make sure, I always like to sell the put option first, because that's, like I said, the strike price that I need the stock to stay below. If you did the opposite by mistake, like let's say you bought this closest option of 655, and then you sold by mistake the one above it, now you've created what they call a debit spread. So it says call debit spread. And you can see that now you owe money because it says the total cost is actually $1.70. So you just want to make sure that you're opening the right trade. If you want to do a credit spread, make sure it says credit spread. Make sure you're getting a net credit on Robinhood. Now, another way to just do this math quickly rather than having to bust out a calculator, you can go to this website that I found called optionstrat.com, and you can see quickly your max loss and your max profit. So I set up the same trade that I just showed you on Robinhood. So March 26th expiration, I have the 655 call that I sold. It says -1. The 657.50 call that I bought, it says, +1. And you can have this little diagram here that shows you the range of strike prices or share prices, I should say, and how much money you would make or lose. So it's a flat line here because, like I said, your max profit is capped at $170. That was the premium that you would collect that I showed you right here, total credit. And then your max loss is again capped at -$80 right here. And again, that's because, like I said, you would have to put up $250 in collateral, which is just the width of your two strikes. However, you're going to take that collateral, subtract the total credit, so $250 minus $170, that gets you your $80 max loss. But your max profit is, like I said, that initial credit you received of $1.70 a share times 100 shares, which is $170. So this is a little bit of a nice representation, and like I said, it does the math for you before you make the trade to see, what is your risk to reward ratio here. Now, if you don't like the graph, you can actually switch to a table view, which shows you numbers. It's a little bit of a heat map, but personally, I find the graph easier to understand. Now, in general, people like to close their credit spreads early. They don't like, in general, to ride them out until expiration and hopefully let them expire worthless. And that's because if the share price ends up being between your strikes, let's say share price on March 26th, Tesla closes at 656. So it's between your strikes. A lot of funky things and a lot of bad things can happen if that share price closes between there in terms of options being exercised and assigned. So you really don't want to be in that position. Again, not financial advice, just my opinion. But a lot of people, if Tesla is trading at $300 a share, minutes before it expires, yeah, chances are Tesla's not going to jump $300 a share in, an hour of trading before the option expires. So at that point, you're probably pretty safe as long as Tesla is well below your strike price of the call option that you sold. But if it's close, a lot of people like to close out these options early, just close out their positions completely before the market closes. That way, they can lock in their profits and not have to worry about what happens during after hours trading. Because keep in mind, you can't buy or sell options after the market closes at 4 p.m. Eastern time. However, you still have another hour and a half where the stock price can fluctuate because options don't have to be exercised until an hour and a half after the market closes, which would be 5:30 p.m. Eastern time. So in theory, let's say Tesla is trading at 654 at 4 o'clock Eastern time when the bell rings and the market closes. Is anything great? Close below my lowest strike price, I'm going to collect max profit. What happens if something crazy happens right when the market closes or some news breaks after hours and then Tesla goes to 670, let's say, right? And that could happen because Tesla's a pretty volatile stock, for example. Well, now in a matter of minutes or maybe in a matter of an hour and a half, you could have gone from getting max profit to taking max loss. So it kind of stinks because you can't trade options once the market closes, but the market can still move. So in general, people tend to try and close out their options early because they don't want to gamble and basically not be in control of what the market is going to do after hours when you're kind of locked into your options. I hope that clears some things up. If you have any questions, the best way would be to join the Discord server and just ask away there. We have a lot of smart and friendly people in the server. Otherwise, just leave a comment below in the YouTube comment section. Add me on Twitter, StockTwits, Instagram, and Reddit. Hope you're having a good day, and I'll see you on the moon.